So we're now thinking about it's called asset location. So where are you saving? Where are you locating your savings so that in the future we can take advantage of the tax code? And many individuals just are not aware that the 0% tax rate exists, and it has for a long time.
This is the Money Seed Podcast, where we discuss all things investing, plain and simple, the way it should be. Please remember, this show is for educational and entertainment purposes only and is not intended to be investment advice. Welcome back to the Money Seed Podcast. I'm thrilled to have Mr. Lance Belline. Lance is a certified financial planner. He's the CEO of Lighthouse Capital, based out of Fayetteville, Arkansas. Lance, welcome to the show.
Thank you, Gabe. I'm super pumped to be on it.
Lance, you've been in the financial advisory, financial planning space now for about 20 years. You've run your own firm now for about 15. Tell me, how old do you think people should be when they first talk to a financial planner?
Well, the younger the better. I guess the short answer is the younger the better. And unfortunately, though, the financial industry is kind of set up to, if you don't have money, right, or extra finances, the financial industry doesn't speak to you, right, because they're generally making the economics of it, right. The more money people invest, the more money they make. So it's unfortunate that that's set up that way, but that's the way it is. So I would definitely encourage people in their 20s or right out of college, even before college, if you can, right, to start thinking about the finances and the importance of saving. Because as you know, I think the most important aspect of accumulating wealth, as Albert Einstein said, is the compound interest, right, mythology, like how wealth grows and compounds. And you only get one chance in life with time, right? So saving early is a very important key to accumulating wealth.
Absolutely. And Lance, quick question. When people go see a financial planner, when I first saw my financial planner back in my 20s, I didn't really know what to ask. I didn't really know what to talk about. It was a very brief conversation, I think at a local, bank or something. And I was out of there in 5 or 10 minutes, and I signed some documents and I bought some mutual funds, not knowing much about what I bought or why I bought it. I guess, what are some of the questions people should be asking their financial planner to make sure they get the products and the services they need?
Sure. I actually have a document that they can go to my website and download, and it is questions to ask a financial planner if you're interviewing. So I'll be at the end of the show, maybe we'll give that, and then that way they can down that resource, because I formed a mastermind group of 7 other firms throughout the U.S. when I was about 15 years ago, and I asked them, I go, we need to help individuals know what to ask. It's kind of like when I go to and my car is broken down and I go to a mechanic, I'm not knowing what to ask. Right. And so key questions, and I think the same thing in the financial industry. People are going and they're like clueless what to ask. All of us brainstormed and came together and put together the top 3 or 4 questions that they would ask. So they're not only going to get the best questions I think they should get asked, they're going to get the best questions 6 other firms throughout the US thought they should ask. So it's a great resource.
Excellent. Yeah, we'll definitely put that in the show notes. So Lance, I think one of the areas where you specialize is helping people structure their retirement portfolio such that they pay very little taxes in retirement, right? And you wrote that book. I can see it, up there in your in the background, right behind you, More Wealth, Less Taxes. And the book talks about how to, among other things, how to structure your investments in retirement and how to really reduce your taxes. Maybe walk us through the bucket strategy that you outline in the book.
Yeah, so I was 37 when I had an aha experience. I was a certified financial planner, so kind of in theory, I should know, right? I'd be very knowledgeable. But like what I learned in life, you can never stop learning and discover new things. So again, I formed this study group, and we were so there's an advisor out of Seattle, Washington. His name is Rich Stewart, and Rich was on a whiteboard, and he goes, "I'm going to show you how to take money out of an IRA and not pay taxes on it." And when he said that, I was like, I don't think that can be done, right? It changed it like opened my mind as far as, well, how is he saying this and being legal about it, right? So that was the first time I had an aha experience. And from that, I come away from that meeting learning that I need to start thinking and better educating myself on how the tax code works, and then how to marry that or partner with that with how I have and what investments I'm investing in and what type of investments. So in short, there's 3 categories a person can save and accumulate wealth for retirement. I call them, I use buckets as the analogy. So bucket 1 would be a person's pre-tax bucket. So if I said a 401k or an IRA, right, a deferred compensation plan, generally speaking, people are very knowledgeable about those because that's what their company has or that's what they've been exposed to. The benefit is it lowers your taxable income. Everybody likes that. Right. But then it grows, and when it never is touched until retirement, and then when you make withdrawals, it's taxed as income. It becomes, in essence, your new W-2 in retirement since you're no longer employed. Bucket 2 is your after-tax investments. We call it, you have some excess income and you want to invest and save. You can put it in the bank. You can put it in bonds or stocks. You can buy real estate with it. That money generally is liquid, and I can get access to it prior to 59 and a half without any penalties. But I have this tax rate that's called capital gains, right? Or if my investments pay a dividend, I have to pay a tax rate. But it's separate than income. And then bucket 3, we call your tax-free bucket. And this was introduced in 1996 when Senator Roth out of Arizona introduced the Roth IRA concept. And that's when this movement started. And so that money is opposite of bucket 1. You get no tax benefits up front, but then the money grows tax-free for the rest of your life. And so when I access it in retirement, I get that money and it's not reportable as income and it's not taxable as capital gains. So those are your 3 categories of investing. And so what we want to do is think about how much we should invest in each of these buckets so that when I reach financial independence age and I get to say I'm done working, how can we kind of dramatically decrease the amount of taxes we pay by taking advantage of the tax code, by withdrawing money from each of these buckets.
And Lance, maybe walk us through some numbers. I think one of the numbers that you present in the book is that it is possible in theory to structure these 3 buckets, and that as you withdraw from these 3 buckets, it's possible to have an annual income of, let's say, $120,000 in retirement and really pay, I think it was less than 2% taxes, if I'm correct. I mean, yeah. Is that even possible? It sounds too good to be true.
Yeah, definitely. I walk you through that, and real life stories are actually better than that. I have in the book, and clients telling their story, but without, it's kind of hard when you don't have the numbers up, but I'll kind of walk people through it. So let's just say hypothetically a person wanted to live on $120,000. So that's what they felt, $10,000 a month. And so what you do is you take 40,000 from each of your buckets, 40,000 from bucket 1, 40,000 from bucket 2, and $40,000 from bucket 3. So that's how I get to the 120. And what we're doing now is, as Uncle Sam considers money from bucket 1, the IRA 401k bucket, as your income. That's your new W-2 in theory. Okay. So 40,000 is your taxable income. You get to lower that by what's called the standard deduction. Mm-hmm. And every taxpayer gets to benefit from this, regardless of what you make. Most people, generally speaking, when they're accumulating wealth, get to use their itemized deduction because they give away to charities more than the standard deduction, or they have a house interest payment, right? The interest deduction they get to deduct. So, but you get a standard deduction. So the 40,000 gets lowered by the standard deduction. And what happens is your income that's taxable gets to be around $19,000. And that $19,000 now allows you to qualify for the 0% tax rate in bucket 2 that many individuals don't know exists. There's 3 tax rates for bucket 2, 0%, 15%, and 20%. And this year, 2023, if your income is less than $89,450, you qualify for the 0% tax rate. So if your income's 19, now I get to have a 0% tax rate for my bucket 2 investments that normally we're getting taxed at 15% or 20%. And the money from bucket 3, so well, to back up, the $40,000 of dividends or capital gains times 0, right, is 0. So that's why there's no tax there. And then the money from bucket 3 is tax-free. And so you're only paying income taxes on that $19,000. So at a 10% rate, that's $1,900. So that's how we kind of are taking advantage of the tax code. So I don't want individuals to qualify for the 0% tax rate while they're accumulating wealth, right? If you're married, filing joint, you don't necessarily, probably if you have children, want to make less than $89,000, right?
Right.
You probably don't have very much money to invest and accumulate with. But if we strategically save, then we can, in essence, camouflage our wealth from Uncle Sam and take advantage of it during our distribution years, right? From age 60 to 75, let's say. And so that's kind of the concept, is thinking ahead of how our money might get taxed in the future to take advantage of the 0% tax rate.
That's amazing. So now that you outlined it that way, it actually makes perfect sense, right? Because your new W-2 income, right, coming from your 401k IRA, that is like 40,000. So then with the standard deduction, you pay very little W-2 income tax. Because you pay very little W-2 income tax, now you qualify for 0% tax on your capital gains. And then the third bucket, your Roth IRA, that doesn't pay income tax anyway. And so now when you add up the $120,000 of income, you're actually paying very little tax. And now that you outlined it that way, it actually makes sense.
Yeah, great. It somewhat is a simple concept, right? But I went, think about this. I went 20 some years, right? From, let's say, when I was 25 to 37, I guess that's 12 years without me thinking strategically. I was very good at helping individuals plan for and know what to save if they wanted to retire at 55 or 60. But Rich Stewart challenged me when he said how to take money out of an IRA and not pay tax. I'm like, well, how do you do that? Well, he did it, but he goes, well, you take out what's equal to the standard deduction. So if the standard deduction is $20,000, I take $20,000 out of my IRA minus $20,000 deduction. It's 0 tax. And that was kind of the concept. So he first challenged me when I was 37 to think strategically. And I'm so glad he did, because it changed my life personally, how I personally save, and most importantly, changed how I impact other people's lives by the advice I'm giving. So we're now thinking about, it's called asset location. So where are you saving? Where are you locating your savings so that in the future, we can take advantage of the tax code? And many individuals just are not aware that the 0% tax rate exists. And it has for a long time.
And Lance, quick question. Let's say if you have a client who goes to see you who are in their late 40s or early 50s, and they're planning to retire in 5, 10, 15 years, but let's say all they only have one of those buckets. Let's say they have a massive 401k account, but really nothing in the other 2 buckets. Do they have options to move the money around?
Yes, but limited. So what we do is, again, as part of we call it an asset organizer. So when I first onboard somebody, and good, I'm looking at, hey, how much do you currently have in each bucket? And we have to then forecast that out based on how they're currently saving. So let's say that they have 70% of their money in bucket 1, 20% in bucket 2, and 10% in bucket 3. And if they're currently saving 70% in bucket 1, right, it's easy, it's forecasting out. And then we can say, hey, what if you change the way you're saving? So maybe we flip it to try to get 70% in bucket 3, for example, and 20% in bucket 2, and 10% going forward in bucket 1. And then what happens is it gets the more equality at retirement. So now I can take my distribution options are much more flexible. And I can get that 40, 40, 40, for example, 40,000 from each bucket. So it's called an asset organizer. Again, they can download it from our website. It's a tool that I wanted to provide free for your listeners and anybody that would help them identify currently how much they have in each bucket. And then more importantly, forecast what they're going to have 10, 15, 20, 30 years from now.
Got it. And we'll put links to those in the show notes. Lance, quick question. Are there any hard and fast rules on who can open IRAs, Roth IRAs, 401ks? It's like, is there any limits on how many different accounts an individual can open up?
No limits, but there's contribution limits. And so Uncle Sam is aware of this tax-free benefit, okay? Because of that, they limit how much you can put in. For example, this year it is in a 401k. If I'm under 50, I can put $22,500 in a Roth 401k. If I don't have a 401k and I'm under 50, I can do $7,500. Or that's that. And so they just don't let us go crazy with bucket 3 because of the future tax benefits. But there's other vehicles that we could do. A health savings account, for example. Individuals, that's open to anybody. You just have to have a health plan that has a deductible, generally speaking. Don't hold me to the exact number, but generally speaking, if the deductible is greater than $2,700, your plan would qualify. And then you can put money in a health savings account, and that money grows tax-free, for future health needs in retirement. I think the key is just looking what's available and looking at a person's situation and see how much they have the ability to save. And then again, making sure they save that strategically in each of the buckets so that they grow their wealth and it's located properly in retirement.
Nice. Lance, getting back to the $120,000 a year, it sounds to me like somebody who is retired, they can have a very nice, very comfortable retirement on $120,000 a year.
Yeah.
Just as a number, I know people talk about the 4% rule, et cetera, but just kind of what size of an investment portfolio or nest egg would someone need to have to be able to have $120,000 retirement income?
Yeah. Well, as a kind of industry standard, as a rule of thumb, is you would take a percentage rate, and usually a safe percentage rate is 4 or 5%. If you didn't want to dip into your principal. So let's just use 5% and we'd take $2 million. So 5% into $2 million is $100,000, right? So it gets you close to that. So generally speaking, I would say if a person didn't want to dip into their principal during retirement, they would need to have a nest egg a little greater than $2 million that they could draw from.
Makes sense. And quick question. Let's talk a little bit more about your book, More Wealth, Less Taxes. I think there's all kinds of really cool stories in there. I believe that the book outlines the bucket strategy in more detail that you just talked about, but there's a whole bunch of other really cool stories. So maybe I think let's talk about chapter 5. You talk about mowing for millions. What's that all about?
Dylan Radcliffe, one of my son's best friends, came to me, and he was wanting to start investing and asking questions. And so, he's an 18-year-old, and he had a fairly good lawn mowing business, and he was making about 10 to 15,000 a year, over a summer gig, right? He had 20 some lawns. And so I showed him that if he would put $6,000 at the time, that was the max, $6,000 in a Roth IRA, and he did that for 5 years. So just during his college, summers, he would have $1 million when he was 60.
Oh my word! Yeah, that's
$30,000 into $1 million tax free. I mean, how cool is that?
That's insane. And again, that goes back to your earlier comment about giving, like compounding. Compounding takes time to work its magic, right? So he's looking at almost 40 years, or give or take 40 years of compounding, and so $30,000 grows to $1 million. That's incredible.
Yeah. It is. It was so much fun to walk him through that process. And when he saw that $1 million, he's like, "Oh my gosh, right? How does this work?" But that's why Albert Einstein called compound interest the 8th wonder of the world, because it is incredible. But many individuals don't get to be impacted by it because they don't start saving yet. And it's understandable, right? Once you grade out of college, trying to make ends meet. You don't have a high, your income just usually pays the bills. But boy, the importance of it. I also have a story in there about 3 individuals, about one person, decided to save right out of college for their first 10 years, right? And so they saved $5,000 a year for 10 years and then stopped saving. And then another person, because they wanted to buy a car, buy a house, they waited 10 years, right? But they saved for 30 years, right? So they started at 28 to 58. And then who would you think would have more money? The person that only saved 10 years and stopped, or the person that waited 10 years, but then saved for 30 years, right? You would think that person would have more money, but it's not the case. The person that saved early, but only for 10 years, actually has more money at age 60 than the person that waited 10 years, but saved for 30 years.
Absolutely. And the math is very clear, right? You got to start young. The younger you start, the better off you'll be.
Yes, for sure.
One of my favorite topics right now is one that you cover in your book. I believe in chapter 9, you talk about the emotions, right? The emotional state of investing. I recently read a book called What I Learned Losing $1 Million. And I'm currently working through a book called Secrets of the Millionaire Mind by T. Harv Eker. And both those books cover that emotional side really, really well. But tell me a little bit more about what you cover in your book.
Well, behavioral biases, if anybody looked that up, it's a study. You can, so the psychology of our mind, but we are wired, generally speaking, to not make good decisions with our finances. And it's because of what's called behavioral biases. And there's a whole study of them. There are a lot of different ones. But in short, I kind of cover some of those. But in short, with investing, it's almost opposite of what normal life is like. For example, when I used a car, if your car breaks down or the check engine light comes on, you're going to take it to a mechanic, right? You're going to get it fixed. If I have, a cold, or I'm going to maybe go see my physician and get medication. With investing, the check engine light comes on when we get a statement and it shows parentheses, we lost money, right? Which is happening right now. In 2022, right, the market dropped for the first 9 months. Oh, it was unbearable almost. And so what we tend to do is we need to do something. I need to make a change. I need to address this problem. But with investing, that's the opposite of what to do. If doing nothing has proven to always be the best solution. So that means we have to manage our behavior to endure those negative months and not get emotional and try to act and make us sell or invest in something else. And that is, in essence, the behavioral biases that we want to cover and try to help people with. So studies show that's usually worse. To my opinion, an advisor that gives real value to their clients is a behavioral investment counselor. They help them manage their behavior, and studies show that's worth a little over 2% annual returns per year if they can just allow them not to make bad decisions. Because think about it, for your listeners, if I get out, let's say I would have gotten out, it would have been rational. Wouldn't you have said in August or September, after 9 months of losing money, you could have rationalized yourself to get out, right? Why would you do that? If the market's going to continue to go down, if interest rates are going to continue to rise, why are we investing? But then what they would have lost out on in October and November actually ranked the best in the top 10 best 22-month returns. And so you missed out on that upswing if you'd have done that. It's just so difficult. The market is so irrational. It is so unpredictable. So the best remedy is to buy, hold, and not even look at it. But it's so hard to do, right? Because it is our money and we think we should act.
Absolutely. Yeah, I think it's well said. There's a couple of really good quotes that come to mind. One is, time in the market beats timing the market. And I'm not sure who that was. I think it may have been Warren Buffett. There's another good one that I read recently. I think that was from Peter Schiff. And he said, the best way to make money from a stock is to not get scared out of it.
Yeah,
And
I love that.
yeah, absolutely. I mean, yeah, like you said, the market's irrational. Anybody who thinks they can predict the market, they're usually wrong, or they're wrong more often than they're right. Do you ever get those phone calls, right? When you have a panicking investor who says, Lance, I invested a whole bunch of money with you like a couple of years ago, and now I just got my statement. I'm down all kinds of money. Lance, what are you doing? I mean, how do you calm that individual down?
Yeah, so as you just kind of mentioned, you try to have some go-to right lines that reinforce, and get them back to thinking correctly. So I say, don't let short-term volatility disrupt our long-term financial plan. All right, so we have built a financial plan anticipating these market pullbacks. We knew that they were going to happen. So we don't want to allow this short-term volatility to disrupt our long-term financial plan. Another thing that I usually will say is that history shows, and you can, this is all statistics, but the market goes up. This dates back to 1929, by the way, goes up 74% of the time. It goes down 26% of the time. And so we are currently incurring one of those 26%. So it's important that if individuals know with investing that 26% of the time they open up their statement, they will be disappointed. But 74% of the time, they're going to be happy. And we just want to reinforce that's why we invest, because the market is the only thing, the S&P 500, let's say, is the only thing that is always recovered, right? That's why the graphs go up over time. It always has recovered. But it's just easier said than done why we're currently going through it, right? It is tough. Bear markets are tough to endure, especially. Think about this. The more money you have accumulated, that means the more dollars you lose, hypothetically on paper, right? So $1 million losing 10% is $100,000. That's a lot of money. $2 million is $200,000. 3 million is 300,000. And so it's the same percent, but the dollars go up. And that's what makes it emotionally more challenging to understand to do nothing is still the right thing to do.
Yeah, absolutely. And earlier you talked about the biases, right? That's how humans are wired, right? Is that we're risk averse. And then all of a sudden when it starts going up, a lot of people tend to, try to lock in their gains by selling too soon. And so it's almost like we're almost wired to do the opposite, right? Like we get scared when it goes down, and then we sell too soon when it goes up, when really in reality we should be doing the opposite. Lance, quick question. Maybe talk a little bit more about how people should look at their investments, their planning, their retirement differently if they are corporate individuals or if they're small business owners.
So the corporate individuals, I want to make sure they understand their benefit, their company benefit plans inside out. And most companies now have a Roth feature that they've added to their 401ks, but not all. I mean, for example, I'm in Northwest Arkansas, Walmart, the largest company in the world, just added a Roth feature to their 401k in 2020. Tyson Foods in 2019. So not everyone, but most companies now have added that feature to their plan. So if you have that feature, I'd strongly look at it. If not, I would strongly encourage your HR person to ask why they haven't added it. And then, there's a corporate employee doesn't have a lot of flexibility of, I would say, growing their wealth strategically, because they're doing that within the benefit plans of the company they're working for. A small business owner, on the other hand, has a ton of flexibility, right? They own the company. They can design their retirement plan the correct way. And for another small business owner strategy that I find is underlooked for individuals that have children of age. And when I say children of age, I'm saying probably over 10 years of age, where you can legitimately give them a job, right? A description of what they can work for, and they can earn up to, so think about this. The standard deduction right now for a single person, the standard is $13,850. So I can pay my child $13,850, they get a deduction of $13,850. That's not taxable. So why would I take that income and just have it and then go spend it on my child for their hobbies and recreations and vacations? So if children at our age, I definitely encourage one of the easiest low-lying fruits, which I don't know why, but it's many times underlooked, is putting your child on payroll when they're of age so that you cannot pay taxes on the income equal to their standard deduction. So I have some clients who have 3 or 4 children. I mean, that's $40,000 to $50,000 that avoided income tax at their rate. And then they put it in their checking account, and then they use that money to fund their 529s, all age, or to, again, for their hobbies, for their interests, for their vacations. So it's that's one low-lying fruit I have for small business owners.
Interesting. Yeah, that makes a lot of sense. Quick question about getting back to the book. I think in chapter 7, there's a good story there about deep freeze, canned beans, and sticky notes. Tell us about that.
Well, it's about estate planning, and I find that's generally a category or a topic that people get a little intimidated by, right? And so it was a story about the estate planning attorney that I interviewed about, he had one client that when she passed, he had given her a document because she wanted particular things in her house to go to individuals. Well, he provided her a form. All right, well, fill this out. And this goes to, Mr. Johnny. This goes to, my nephew. This goes to my daughter. And she didn't fill that out. But what she did is took sticky notes and put them behind, like the pictures, or put them underneath the vase. And so when they were going after her passing, they got together as a family, and he opened the document, and it wasn't complete. And he was like, I know she did. I know we've talked about this. And one of the grandsons was just messing around, right? Because he's bored, a little toddler. And he came back with a little sticky note, and it said the name that was supposed to go to. And so then the family kind of had like a, they were going around the house like it was like some party, like, oh, found one, right? Everybody was celebrating. So the estate planning can be that simple, right? A sticky notes on an item legally designated who got what, within her house. And so as just an example, which I thought was really, cute.
It's like a scavenger hunt kind of thing, right?
Yeah. He recommended this person keep their trust document in a very safe place. After their death, they could not find it anywhere. He had a copy of it, but, and then the house sold, emptying out the house, and their son found their estate planning documents in the freezer, like in the garage. That was the safe place. I thought that was, hilarious.
That's pretty funny. Yeah. Let's talk a little bit about the future. In general, Lance, when you meet with a client and let's say someone in their 20s or 30s, and you sit down and you start projecting out what the next 20, 30 years looks like, what is a typical S&P 500 growth rate that you assume in your mathematical models?
Well, planning models, we kind of under promise and try to over deliver. So we're using 7 to 8%. But obviously, if you just, anybody Google that, the S&P on average is over 10%, right? It's around 10.5. So for planning purposes, we're using 7 to 8%. I know many advisors use greater than that. I'm totally fine with that. It's just, we got to keep people invested, right, for 30 years in order to get that return and not short circuit ourselves, right? Not ever sell. So that's why we use a little lower rate just to protect, because I don't want to get somebody to age 60 and then have to tell them they had to continue to work, right? And that's never a fun story. And
what is your personal view? This is an opinion type question, but on Social Security, I mean, there's a lot of stories out there about how, with the recent government spending and, $31 trillion debt, et cetera. Do you think Social Security is going to be impacted at all, like negatively impacted in the next 20, 30 years? Do you think it's still safe for people to assume Social Security is going to be there for them? And maybe I'm going to tackle one more question is, do you think taxes long-term will go up as well?
Well, those are 2 big loaded questions. I would say Social Security, in my opinion, will not get impacted to people that are receiving it. because they vote, one, right? They're the baby boomer population. I think what's going to happen is for you and I and others that are in their 20s, 30s, 40s, the age of full retirement is going to continue to get extended, right? So I don't anticipate, Gabe, you to qualify for Social Security at age 66.
Mm-hmm.
I think it might be 70, 71, 72. Obviously, all of our deposits we're making into the Social Security system is going right out into my parents' mailbox and your parents' mailbox. So the program is obviously not is broke and is projected to run out. But like any politicians do, they generally find a way, right? They'll find a way to keep it because it's such an important aspect to a person's retirement. For taxes. I think, again, that's the premise of my bucket strategy. As I would rather pay some taxes now because historically, and I want your listeners to Google this historical federal tax rates. And they're going to see a graph from the beginning that shows we've had tax rates as high as 90% in our U.S. economy, 70%, 50% just in 1980s. So we are currently in a low tax rate environment. And I know people feel sometimes they're getting taxed to death, but taxes can go up. And I think they will go up because our federal programs, right, are in deficit mode. Medicare, Medicaid, Social Security, they have to raise revenue and or decrease expenses. And politicians aren't great at decreasing expenses, right? Because they like to spend, once they get programs, they don't want to go without them. So if I can get more of my wealth accumulated in buckets 2 and 3, so that in the future, if tax rates are higher 20, 30 years from now, I don't have to worry about it, right? Because if I can get money tax-free, I don't care what the income tax rates are. So that's another premise of the bucket strategy I feel is going to be beneficial, as individuals will not be subject to the IRS tax codes as much in the future if they save their wealth strategically today in buckets 2 and buckets 3.
Yeah, good point. Yeah, that's right. That's another reason, I guess, to look at the IRA, the Roth IRAs, et cetera, is because you are shielding yourself from potential future income tax rate gains. That's actually a good point. Sure. Yeah. Lance, I know that you have some children. I have some children. Any good parenting tips? I mean, because in terms of finances, I'm always out there looking for some good advice on how to teach kids about money. I have 2 daughters. One is 15, one is 10. And, the 10-year-old still, she gets $5. She's happy. Like she doesn't really, money is not a big thing about her. But my 15-year-old, she's at the stage in her life where she's going out with her friends on the weekends. They're going shopping. She can buy stuff online because she has her own little, MasterCard, like debit card thingy. And so we can put money on her card and then she can go buy stuff on the internet with it. And so any good parenting advice for teenagers?
Well, I wish I have some advice. I can't say my kids subscribe to it very well, but I have a story in the book about the $10,000 Coke. I'm like, what does that mean? Well, it's about if you go out and eat at a restaurant or you every day go to a convenience store and you buy a Coke with your meal or go to the convenience store, that's generally $1.50, right, to $2. And let's just say if you did that, for you avoided doing that, you order water. Yeah. So that, what does that look like? So that's $2 a day. That's $10 a week. That's $40 a month. At $40 over a 10-year period grows to over $10,000. So I tried to kind of give some analogies like that would help them. Like, I'm going to order water versus a Coke because I'm like, did that Coke really impact your life that much? Right. And I also use that for individuals that feel they can't save a lot. They don't have enough excess income. I think they always can if they just are willing to kind of go without some of those conveniences that we get used to. Another one I would encourage is I did this with my daughter, and this one did work, is I put her in charge of her finances at age 18 when she went to college. I had a 529 plan. We opened one up for her. I transferred money into that. I go, you're in charge of your bills. No longer am I. We also got her an actual credit card with a $500 limit. I set up that credit card to pay in full every month. I said, every time you go to the gas station, use this credit card. She has a 780 credit score right now. She's a junior in college. So those two things I thought have taught her a lot. One, I'm not getting called every time she needs money, right? She's responsible for it. And two, she now has a really good credit score because we set it up, that for the last 3 years that she's been using. So your children aren't quite at that age, but obviously being self-employed with your show, I would strongly encourage you to say, could your children help you with some of your social media, things that would validate you to pay them an income, right? So that income can avoid getting taxed up to the standard deduction.
Absolutely. Yeah, I think you said a couple of really good things there. I really like the second thing you mentioned about the credit card, right? Because they have a credit card in their name, which means it's their credit score that is improving every time. And then you make sure that, with your help or with their help, but it's paid off every month. So by the time they graduate, they have 3-4 years of like a solid track record of paying off their credit card every month. And like you said, like they have a really good, really high credit score. So I think that's a fantastic way to help out your kids as they go through college. And I also like the idea that you mentioned, and I'm working on with my 15-year-old on that right now, is to get her to help me out around the house, including like helping out with the podcast and other stuff, and trying to get her to earn her own money a little bit. The other thing that I'm trying with her, and she hasn't caught on yet, is I started noticing that when she was like 10, 11, etc., and she would get some money on her birthday from the grandparents or some money for Christmas or whatever, she would just spend it. Like she's a kid, she goes, "Oh, I got like $20, and then boom, she spends it in like a day." And so I told her, I said, "Okay, look, you're 12 years old. Between now and your 18th birthday, whatever money you have in your bank account on your birthday, I'm going to double it. Like if you have $50 in your bank account, I'm going to give you another 50 and you're going to have 100 in your bank account." And I'm trying to get that. I'm trying to get this idea of compound interest, through her head, right? Like, hey, if you just wait, it's going to grow and grow and grow. And she's 15 and the light bulb hasn't gone on yet. So if she gets money, boom, it's gone like within a week. So I'm hoping that, one of these years, she's going to all of a sudden realize that what a fantastic opportunity I gave her. But she missed the first 5 years of compounding already. So
I know. I wish I could say I had a different story, but I'm the same.
Cool. Lance, as we move toward wrapping up the show, again, just want to highlight the book, More Wealth, Less Taxes. Fantastic book with great tips on how to set up the bucket strategy and some other war stories that you came across during your 20 years. Congratulations again on running your own firm now for 15 of those 20 years. Lance, what's the best way for people to reach you?
So my website is my name, Lance Belline, BELLINE.net. And so lancebelline.net, they can download any of those resources we talked about, either the asset organizer, the questions to ask or interview for a financial advisor. So there's some other tools there as well, as far as a decision tree, as far as when do I invest and what. And then company's website is LHfinancial.net. So that's, Lighthouse Financial, but it's LHfinancial.net is another way they can get exposed to me.
Perfect. One last question, Lance. I see that your name in the background above you there, Lance Belline, CFP, which is Certified Financial Planner, and I see CHFC. What is that? What is the second one there? What's that designation?
It's called Chartered Financial Consultant, and so that that goes back. I mean, that just goes back, generally speaking, from the people that were in the life insurance industry. That kind of that's when they created that designation. There's also a chartered life underwriter, but chartered financial consultant is from that. It's just similar to the CFP, but the CFP is probably much more of a brand named designation that all advisors should try to obtain, I think.
Excellent. Lance, appreciate your time. Thanks very much for joining the podcast.
Absolutely.